Paul, let's talk about our first company.
Paul, stand on the chair. Matt, you're fired. All right, Kohls is our first company, correct?
Yes, it is, brother.
All right, guys, look at this Kohls stock. This is a whirlwind over the last year. Okay, market cap, $6.9 billion. Now, obviously, the last year has been tough. It is a negative PE, so that's an X. Profit margin, obviously, is an X because they haven't made money in the last 12 months. But look at this gross margin. This gross margin is solid, 39%. They used to pay a dividend of 6%. Now they pay 0. It makes sense. They want to conserve their cash. But so far, 2 X's. But again, this is one of those examples of it's retail. It's been hurt a lot in the last year. Let's look at how they're rebounding and what their future plan is going forward.
Pillar number 3 is revenue growth over the past 5 years. Paul's going to look at the revenue on Y charts, and I assure you guys that moving forward, we'll be looking at all of these stats on our own Everything Money website, which we'll show you later. So go ahead, Paul.
19.2 to 18.9. Keep in mind, this is going to January 2020. And also, for the new Everything Money website, the years will not be the most recent full year. It'll be the most recent 4 quarters. It'll be split up at 4 quarters at a time. That way it's more accurate in terms of years. I don't like the way Y Charts does it. That's one thing I'm changing there. So it is an X here on revenue growth.
How about profit growth? Pillar number 4 is profit growth, Paul.
Before the shutdown, 673 to 691. It is a check mark. But as you remember, in the last 12 months, they have lost $207 million. But it's still a check mark based on what we're doing for this analysis.
Pillar number 5 is shares outstanding, Paul. We obviously want this number going down. Not very obviously. Why do we want this number going down, my friend?
When you have a big pizza pie split 4 ways, when you're issuing more shares, you're cutting up the pizza into more slices. So before, you owned 1 slice that was this big, now it's this big. It's kind of the same pie more ways, but when they're taking shares away, it's almost like they're taking away slices of pizza. You're getting a bigger piece of the pie. So as an example, if a company makes, the bottom line is, if a company makes, the company has 10 shares outstanding, it goes to 9, you own 1 share, you went from 10% up to 11%. If it goes from 10 to 11 shares, you go from 10% down to 9%. So you want the shares going down, and that is a check mark here. Significant decrease in the share count, almost 25%.
Pillar number 6 is current assets greater than current liabilities. We want, obviously, them to have more assets than liabilities, Paul.
Current assets, cash on hand is about $6 billion. Current liabilities, 3.75, so check mark there.
What about total liabilities, Paul? We're getting close on that. What do you think?
Total liabilities is $10 billion.
Okay, not as good. I hear you.
I mean, the reason I don't like looking at total liabilities is because there's so many things that make up total liabilities. If they owned all their real estate and they had assets behind it, that's a totally different debt than just a lease obligation. So that's why people have asked, why don't you look at total liabilities? I do, but I want to see right now, how is their strength in the current position right this very second?
We're looking at Kohls right now. We're through 6 pillars. We have 3 X's and 3 checks. Their PE ratio is low. Their PE ratio is a bit high. There's no PE ratio, and the profit margin is terrible because they haven't been making any money. Pillar number 7 is free cash flow growth. This is one of the most important pillars in Paul's mind.
Okay, so free cash flow before this year. So this is 700 million to 800 million. So check mark there. Average of 1.4, 1 billion, and 1.6 billion.
Getting the free cash flow average right now, divided by 5. Free cash flow is 1.1, Paul.
1.1 billion.
1.1 billion.
This is retail. Usually we sit there and say we want it less than, what was the market cap of this company? Did we even look?
7 bill.
7 billion. So right now, it's selling for about 6.5 times free cash flow. Check mark there. Now the question becomes, where is free cash flow going? So it's a check mark on both free cash flow growth
and price to free cash flow.
Now let's see what's done the last 12 months. Last 12 months.
While Paul's looking at that, make sure you guys are tickling that thumbs up. We really appreciate your support. 158 of you watching, we welcome you in. And make sure you're giving Paul a little tickle on his backside. He enjoys that. So go ahead, tickle that thumbs up.
In the last 12 months, they've done 1.1 billion in free cash flow anyhow. So the average is what they've done in the last 12. So you got to decide to yourself, is 6.5 times free cash flow worth it for a company like this? Boy, it just seems cheap. It doesn't seem like a lot of money to pay for this company is very large. Let's see what their income has been for the last 12 months while they were in shutdown.
Please do.
it fell to 15.7, and quarterly, I mean, look at this. So the quarter, 6.5, and it's growing back up again. It's almost back up. And the thing I like about Kohls, guys, I do know this about Kohls, they're trying to make it very easy for you to return. They're trying to make themselves a center for Amazon returns. Because they want you walking into their store and going, oh, you know what, I need this. And they're trying to make themselves a hub for Amazon.
Do you know when they did that?
Say again, Mo. I'm sorry. Go ahead, Mo.
It was years ago?
Yeah, years
okay,
ago.
I thought it was right before coronavirus, and then that happened. It's like, oh, well, people don't go to stores anymore. Okay, good.
No, they've been
That's
doing that
good.
I think they tested it in different stores for a while.
That's a great way to drive people to your stores.
Absolutely. And so, to me, 6 times free cash flow is awesome. Where was it? I mean, look at where it was. If you were willing to look past the fear of it, guys, it was selling for what was it selling for here? 1.5 times free cash flow back in the fall, back in the collapse of COVID, back in April. Listen, I think you should do more due diligence. What's their debt look like? How much of that $10 billion is lease obligations? Retail is dying, but it's not going to go away forever. I think Kohls is kind of like what's the market for Kohls? Like, who goes to Kohls?
To me, I think it's like moms and dads with school-age kids that go and buy discounted shoes, and I mean they have everything at Kohls. I think you can get.
Say that again, Don.
My wife shops there too.
There you go.
Yeah.
I know they have like bedspreads and kitchenware and whatnot also. So.
Those Nike swoosh things I got those from Kohls.
Oh really?
Yeah. I did it online, by the way. So you look at these things saying, well, how much is Amazon going to be affected by it? I mean, listen, people still like going out to shop. The question isn't, are all shops going away? It's which shops are going to go away. So you got to understand more of, does Kohls have what it takes to make it long-term and be a player? I mean, $18 billion. I mean, look at TJ Maxx. I mean, TJ Maxx, I think it's going to be hard for TJ Maxx to go completely gone because they have a very specific, but either way, we should actually add TJ Maxx to this list. Maybe we'll do that at the
They're a
end.
great brand.
For the first time ever, should we let Mo talk about momentum?
Let's do it.
Yeah, so before I get started on this, let's remember that value investing and trading are very different. So when I talk about something that's going to fall on us, it's not necessarily based on what Paul was talking about. So I'm going to use this as a teachable moment. And we've talked about, you've seen my videos online about the 50% rule, and this is a perfect example. This is going back to May of 19. We have a top here, a bottom here, and we're kind of in this in-between range right here. So this stock, this right above here, this is called overhang. This is the area where there is a lot of resistance. So we can see that it's coming up and it's getting into this overhang area. More likely than not, it's going to fall on us. And let me zoom in here and show you the trend today.
What do you mean fall on us?
Say that again, Paul.
So the
do you
stock
mean
price,
fall on
I'm going to
us?
show you right now.
Okay.
So as you can see, we had a trend. This is our sweet spot between 80% and 32% on our stochastic. Moved up and it just went sideways for a very long time. As you can see, the stock price continued to climb. Today, we got our first red candlestick on the long-term trend, and our stochastic line dropped into the sweet spot going in the negative direction. So for me, I'm looking at a short on this stock today. I'm going to throw one tracker share on there. You've seen me talk about tracker shares in my YouTube videos, and just keep an eye on it, and let's see if this thing continues in a downward trend.